In episode 11, I will explain the ICT suspension block. Most traders misunderstand this concept or ignore it completely. By the end of the video, you will have a clear understanding of how it works and how to use it in your trading. So, let's get into it. So basically, for you to understand what a suspension block is, you first need to understand what a volume imbalance is and what a fair value gap is. If you don't have a clear idea about these two concepts, then you should learn them first. I've already explained both of these concepts in my previous videos, so you can go and watch those if you need a deeper understanding. Now let's talk about what a suspension block actually is. A suspension block is essentially a candle body that is surrounded by volume imbalances on both sides. In simple terms, you will have a volume imbalance between the previous candle and the current candle, and another volume imbalance between the current candle and the next candle. The candle that sits between these two volume imbalances becomes the suspension block. But there is an important detail here. Many people might think that this is just a normal fair value gap combined with volume imbalance, but that is not correct. In a suspension block, you only need volume imbalances around the candle, but there is no requirement for the wicks to stay outside the block. The wicks can actually come inside the suspension block. That means there might not even be a clean fair value gap, and it can still qualify as a suspension block. Now let's look at an example. In this chart, I first marked the previous day's wick and divided it into quadrants. If you're not familiar with quadrants, this is basically done using a Fibonacci tool, and it helps us identify where PD arrays are forming inside the wick range. Here I've marked the lower wick of the previous day's candle. Now if you observe the example closely, you can see that we have an imbalance forming above the equilibrium of that wick. Price respects the fair value gap in this area, but notice something interesting. Price keeps trying to close above the equilibrium of the wick, but it fails every single time. What does that tell us? It shows that price is likely to move lower, and the draw on liquidity becomes these equal lows that were formed earlier in the morning. Now look at what happens next. Price taps into this order block by just a small margin and then rejects very aggressively. After that rejection, we start seeing a series of confirmations. We get lower time frame manipulation, where price first sweeps the highs. If you look carefully, this happens during the second macro time window of the day, which is roughly between 11:50 and 12:10. Price sweeps the 11:51 candle around 12:04, and after that we start seeing multiple PD arrays form. At this point we have an inverse fair value gap, a breaker block, an order block, another fair value gap, a market structure shift, and a change in state of delivery. Essentially, we have several strong PD arrays forming in the same area, and all of them start getting respected by price. Now this is the important part you need to focus on. You can see there is one volume imbalance on one side, another volume imbalance on the other side, and there is a single candle sitting between them. It does not matter whether there is a fair value gap or not. In this example, there actually is a fair value gap, but that is not the requirement. If we mark the entire range from the first volume imbalance to the second volume imbalance, that entire area becomes the suspension block. And this block tends to be much stronger than a normal fair value gap. You can see how price reacts from this level. Price pushes down aggressively from the suspension block and never even manages to close above it. Look at the reaction that comes from that level. This kind of reaction usually indicates institutional activity. This is where large orders from big players are sitting in the market, and that is why price responds so strongly from this area. So that is essentially what a suspension block is and how it works in the market. So here we have one more example of the suspension block. If you look at this chart carefully, we already have a bearish bias in the market. As you all know, there are multiple ways to determine the draw on liquidity and the overall bias. But in this example, we are again using the wick quadrants just like we did in the previous example. You can see that we already have our daily wick quadrants marked, the same way we marked them before. These quadrants help us understand where price is positioned within the daily wick range and where the equilibrium of the wick is located. Now if we move down to the 4-hour time frame, what do we have here? We have what some people might call an order block, and some people might call a change in state of delivery. Honestly, it doesn't really matter which one you consider it to be, because both of them indicate the same idea. which is the willingness of price to distribute lower. Another thing you can notice here is that once price closed below the 75% level of the daily wick, it never managed to close back above that quadrant level again. This is another important clue showing that price is not interested in moving higher, and instead it is showing the intention to move lower. Now, if we move over to ES, you can see something very interesting happening between ES and NQ. We have a smart money divergence between these two hourly candles. ES actually took the high, but NQ did not take that high. This creates an SMT divergence, which is something I personally like to use as an extra confirmation. Because of that SMT divergence, I would prefer to take the trade on the instrument where the SMT signal is present, because that often gives us a higher probability setup. Now, if we move down to the 1-minute time frame, you can immediately see that we get an instant change in state of delivery. But there is something even more important forming in this area. At this point, you should already be able to recognize what is happening here. We have one volume imbalance here, and we also have another volume imbalance right here. Now, if we look between these two imbalances, you might notice something interesting. Do we have a fair value gap between them? No, we actually do not have a fair value gap here. So some of you might start thinking that this might not qualify as a suspension block because there is no fair value gap between the imbalances. But that assumption would actually be wrong. As I explained earlier, for a suspension block, it does not matter if the wicks interfere with the structure, and it also does not matter if there is a fair value gap or not. The only requirement is that you have a candle that is surrounded by volume imbalances on both sides. So when we mark the area from the first volume imbalance to the second volume imbalance, the entire zone becomes our suspension block. Now watch what happens when price returns to this level. Price comes back and taps directly into the suspension block, and almost immediately after that it rejects from the level and moves lower. And as price moves forward, you can see that it goes straight into the targets, which in this case are the sell-side liquidity resting below. So you can clearly see how effective and powerful suspension blocks can be when you combine them with bias, SMT divergence, and lower time frame confirmation. Price simply taps into the suspension block and then delivers the move exactly where we expected it to go, which is straight into the sell-side liquidity resting below. You can see how clean and simple the reaction is, and that is exactly why this concept can be so powerful when used correctly in your trading. Alright, so that's the concept of suspension blocks and how you can use them in your trading. The main thing you need to remember is that a suspension block forms when a candle is surrounded by volume imbalances on both sides, and it does not necessarily require a fair value gap, and it also doesn't matter if the wicks interfere with the structure. When you combine suspension blocks with the higher time frame bias, draw on liquidity, and lower time frame confirmations like change in state of delivery, they can become very powerful levels where price reacts with strong moves. But like always, don't trade this concept in isolation. Make sure you align it with your overall model, liquidity framework, and market narrative. If you found this video helpful, make sure you like the video, subscribe to the channel, and share it with someone who wants to improve their understanding of price action. And with that being said, I'll see you in the next one.